Welcome, everyone. Thank you for attending this fourth installment of our Risk Reveal series, US AML Reform, the regulatory impact on digitization and the new banking landscape. My name is Karin Rines, and I'm the Marketing Manager for the Risk Business at Refinitiv, and I'll be your webinar host today. Before we begin, I'd like to cover a few housekeeping items. First, some technical points to note. There is no dial-in number for the audio. Your device's sound is what will broadcast the audio, so plug in your headphones to listen to this webinar. Click the media player on your screen to enable the sound and ensure that you have Flash enabled on your browser. And if your screen freezes, refresh your browser. Usually that'll unlock it. If you have any technical difficulty during the webcast, please click on the Help widget, which is the question mark icon on the toolbar at the bottom of your screen. This covers troubleshooting for common technical issues. You can expand or minimize your slide and video windows by clicking on the Maximize icon on the top right corner of the window, or by dragging the bottom right corner of the slide area to expand it. At the top right corner of your audience console is the Q&A box. Please submit your questions in this box. Our presenters will answer as many questions as they can during the last 5 to 10 minutes of this broadcast. Finally, the link to the recorded webcast, a copy of the slide deck, and other resources will be emailed to you after the conclusion of this event. Now, I'd like to introduce you to our panel moderator today, Susan White. Susan is Head of Business Development in the Americas at Company. She works with clients and partners to provide solutions for their specific compliance and regulatory challenges. Company is an industry leader in providing real-time audit-proof business verification data for businesses, KYC, KYB, and AML needs. With that, I'm going to go ahead and turn it over to Susan to introduce our panel and get the discussion underway. Susan?
Thank you, Karin. Hello, everyone, and welcome. Thank you for joining us. We're excited that you're here because we're expecting a lively discussion from our panelists. They bring insight and passion to AML, regulation, and digitization. And as Karin mentioned, you feel free to ask questions as the session is running in the Q&A function. And if you have a question for a specific panelist, please specify that. It's my pleasure to welcome our panelists. Kate Banks has spent more than 20 years working in compliance focused on KYC and AML for JP Morgan, Bank of New York, ING, and AIG. And she's been in roles that many of you are in now. In her role as risk proposition specialist at Refinitiv, she uses her experience and expertise to guide financial institutions as they embrace automation. Chris Tosin is head of risk data analytics and automation at M&T Bank. Chris has firsthand experience with evaluating and automating operations relating to regulatory change, both the anticipated and the unanticipated. Rachel Woolley brings a strong background in global regulatory compliance, specifically relating to AML. And Rachel works with clients as they navigate through automation and the regulatory environment in her role as Global Director of Financial Crime at Fenergo. Jeremy Kuster has a background that is anchored in senior roles at the US Department of Treasury, which included FinCEN, where he drove efforts to be more responsive to how technological advancements impact the conduct of BSA and AML compliance. He's leveraging this knowledge now as legal counsel for White & Case in Washington, D.C. to help clients meet their AML goals. Welcome, all of you. And first question, can we go to the next slide? Thank you. Jeremy, a number of AML policy issues have been coming to a head during this latest session of Congress, from glaring gaps in AML coverage to structural inefficiencies in AML compliance. And to address these issues, there have been bills and amendments that have been winding their way through Congress. Are you able to give us a quick overview of what was introduced and where we stand now?
Sure thing, Susan, and thank you for having me today. I think there are two real principal bills, though there are usually many more that are advanced in each session of Congress. But the two that are most relevant are the Corporate Transparency Act in the House and the what is called the AML Act in the Senate, which is was previously proposed as the Illicit Cash Act. The Corporate Transparency Act was passed in the House previously, and it included something called the Counter Act. And so the two major parts of that bill were a beneficial ownership requirement, requiring individuals who are registering businesses to report that information to FinCEN. And then there was another part of that, the Counter Act, which was a general AML reform bill, which sort of talked about Sar Reform, structural reform of FinCEN, privacy issues. In the Senate, the major bill, as I said, was the Illicit Cash Act, which in many ways mirrored the Corporate Transparency Act. It also had a beneficial ownership requirement, and it sort of took a slightly different approach to AML reform, focusing a little bit more on feedback from law enforcement. The Senate has not taken up the Illicit Cash Act for full Senate consideration. I don't believe that it's even passed through committee quite yet. However, with the term coming quickly to an end, I think there was a thought that maybe we could attach these AML reform bills to a must-pass piece of legislation, which is the National Defense Authorization Act. The House attached an amendment to their version that pretty much mirrored the Corporate Transparency Act. And on the Senate side, there was an amendment that was submitted that contained the AML Act, which was said was previously the Illicit Cash Act, but it was never actually proposed, so it was never voted on by the Senate. However, the version in the House was voted on and was included in the House's version of the NDAA. It's hard to tell without insider information whether that will go through in conference, but my bet is probably not. I'm not particularly confident that these bills will move forward. And I think one of the telling signs was the Senate didn't take up their version of the amendment. So there's no real record of how much support there is in the Senate. I think as this is a must-pass piece of legislation, which still hasn't passed, I think there's going to be a bit of pressure on Congress to come to a pretty vanilla NDAA. And I suggest that it's not going to include the AML reform bills, but I've proven wrong before. Now, I know there's a lot of interest in the beneficial ownership side of the equation, and we can talk about that a little bit. But I do think that there's also some really interesting aspects to the broader AML reform, like Sar reform, that I think should get a lot more attention. And another aspect that's not discussed in the legislation is all the efforts of the regulators over, I would say, the last 2 years, who are growing more receptive to AML reform initiatives. There's an ABSA reform working group between Treasury and the various regulators, and they put out some product that are actually quite interesting. So there's a lot of movement in this space, and it's not just in the legislation. So we shouldn't hang our hat totally on it, but there is some really there's some opportunities there as well.
So the sentiment is moving towards the reform, you would say.
I would say beneficial ownership is still very important. My personal perspective is that it is very important, but as currently constructed, it's not going to be implemented for quite some time. FinCEN is not built to manage information in this way. It's going to take at least 2 years after the passage to promulgate the regulations and start the reporting. And by then, you may or may not have FinCEN ready to ingest the data and then be able to share it back with financial institutions. I don't see financial institutions having to change their CDD procedures for many, many years until after this legislation passes, if it ever actually does. However, opportunities in Sar Reform, I think, are more immediate. I think there are opportunities to talk about feedback from law enforcement. I think there's opportunities to talk about automated SARs that can really change how a financial institution conducts AML compliance and investigations that are much more immediate and there's much more opportunity to advance the cause.
Right, and certainly Rachel could actually give us some insight because into what we might expect here from a beneficial ownership perspective, and also maybe from a SAR reform perspective. And Rachel, Europe is no stranger to regulatory reform. What sort of challenges did financial institutions face as they tried to comply? What worked, what didn't? Do you have advice for U.S. financial institutions?
Yeah, I guess advice and maybe some fair warning as to what's occurred in the EU over the last number of years. So anyone who is familiar with the approach that the EU takes. You may have heard of the EU AML Directive. So right now we're a few months past the deadline date for the 5th AML Directive, and we're a few months ahead of the deadline date for the 6th Directive. So there's been quite a lot of reform or overhaul of the AML environment in the last number of years. Now, the directives introduce different requirements, so it's not all the same thing changing all the time. But certainly one of the key trends that we've seen is continued enhancements to the beneficial ownership regime across the EU. One of the big issues from an EU perspective is that the way that the directives behave is that every member state in the EU is required to transpose the requirements into national law. So what that leads to is essentially divergence in terms of, one, the interpretation, and two, the timing that becomes applicable in national law. So again, if you're operating cross-border in more than one member state, you may be subject to different requirements for the same customer types and so on. The big thing that I think really caught people up under the 5th directive. So once the registers of beneficial ownership were introduced under the 4th directive, there was obviously a requirement on legal entities to register that information with the local company registrars. Under the 5th directive, that information was made publicly available. However, it cannot be used by financial institutions to identify beneficial owners for onboarding purposes. And in fact, it went a step further and put an obligation on financial institutions to collect beneficial ownership information independently, compare that information against the national register, and there's an obligation actually to report any discrepancies. So in summary, discrepancy reporting is now applicable for member states that have transposed the 5th directive. So that's put an incredible operational burden on an already burdensome process of onboarding. And really, certainly when you're looking at new regimes introducing corporate transparency and so on, the question is really around the validity and the accuracy of that data. So, introducing a requirement to register beneficial ownership information, it guarantees that information is only reliable or only accurate at a point in time. It doesn't guarantee that information continues to be accurate and continues to be usable. So there really needs to be a lot of questions asked as to who that responsibility falls to, who verifies that information. We know in the EU already that a lot of corporate registries don't actually verify any of the information provided to them. It's to some degree taken at face value, which also raises concerns then because, even if the information is provided, there's no guarantee that it's accurate or that it's truthful. So there's a lot of questions to be asked around, as I said, the validity and the reliability of that data. So it really brings into question the point of introducing corporate transparency if that's not going to be managed appropriately. And to Jeremy's point around being equipped to deal with that, it's similar, and I'll digress a little bit to the Sar Reform piece. It's similar in that sense, and part of the reason, I suppose, that information is no longer or is no longer considered reliable or accurate is because there aren't sufficient resources to make sure that that's the case at the company registries. And it's the very same story that we've seen in a lot of financial investigation units across Europe. Thousands upon thousands of suspicious activity reports are submitted to the FIUs every year. And if you look at any of the mutual evaluation reports published by the Financial Action Task Force in recent years, a lot of them call out an issue around resources in the financial investigation units to actually adequately assess those reports. So there's a lot of activity, I suppose, in terms of how to automate or increase the efficiency of that reporting process and really make sure that we're adding value in terms of the analysis and investigations that are subsequently undertaken. So lots of further collaboration, I think, that's required across public and private partnership industry and so on. But I definitely think, both the EU and the US can certainly learn from each other on how to create that holistic environment to prevent financial crime.
Yeah, and I wanted to, for you and Jeremy, if you can talk about a little bit about, a little more insight, of like the cost of non-compliance, how quickly you're seeing regulatory change, and maybe touch upon some of the lessons that were learned both here and abroad, and I'll open it up to the two of you.
Well, why don't I lead off? Just the pace of regulatory change, I think, is one that you can't view from just a single lens, particularly if you're an internationally active financial institution. The U.S. has been sort of slow recently, not a lot of new rules being promulgated, some guidance, but not a lot of new rules, not a lot of enforcement on AML. Particularly recently, particularly in comparison to previous administration or years. But it's been very active worldwide. I think there was some reporting that came out a few weeks ago that enforcement penalties are the highest they've been worldwide. And as Financial Action Task Force is being more aggressive with mutual evaluations, you see a higher pace of regulatory change in certain areas. And as Rachel mentioned, and she can certainly talk about this more extensively than I, we're on our 6th AML Directive. And that's only in a space of a few short years, really. So change is very rapid in this space.
Absolutely, and we're heading into further AML reform. So consultation paper is currently open, and a particular focus actually on the digital finance strategy in the EU. So there's more change yet to come. So that change is almost never ending. It's the only thing that you can pretty much guarantee will happen is that it's going to change again. The enforcement actions absolutely is a key consideration as well. And I suppose, everyone hears of the enormous fines that are issued to financial institutions. We've published research on that recently, and some significant trends in the APAC region, actually, where as a result of the fact that some regulators are becoming more active and issuing financial penalties. But really, I suppose, in terms of some of the discussions that have emerged in recent years and some of the high-profile investigations that have taken place that are, everybody is familiar with. And it really comes down to, not just avoiding financial penalties, but really getting to the root cause of why these issues are occurring. And it's making sure that, regardless of the legislative requirements, that ultimately the systems and controls that you're implementing are really designed to be effective and efficient in terms of addressing financial crime issues.
I couldn't agree more. Thinking ahead of and trying to keep pace with regulatory change, I think, is not a winning strategy for a financial institution. It's thinking about the core principles and how you implement the core principles. And I think those are pretty solid. Risk-based approach, really deeply understand your risks and take appropriate mitigation in that way. From a financial intelligence perspective, understanding what the value of financial intelligence is, from a bulk data perspective and a predictive perspective, and dedicating your resources that way. And certainly we'll talk to Chris a little bit more about some of those issues a little bit later today.
Yeah, this is a good inflection point for our first polling question. So we're going to go on to the next slide. And how is your institution monitoring for suspicious activity around PPP and IDLE? Are you using analytics? Are you doing ad hoc reporting? Are you catching the activity through current behavioral detection platforms? We should be monitoring that activity differently. So if you can, we'll give this a few seconds. And Karen, I'll defer to you as to when we should move to the results.
Sure, I'll just give the audience a couple more seconds here to enter your answer, and we'll pop over right now.
Okay, so Chris, I wanna ask you if there are any surprises that you're seeing here.
Yeah, I can't necessarily say that there's anything that's truly surprising in the space. The nice thing is that we're seeing a very small amount of folks saying that they didn't know that they should be monitoring that activity. So it means that people are paying attention to this and utilizing the technical aspects or the things that are already in place to catch this activity. I would say for those 30% that are saying they're catching the activity through current behavior detection platforms, that might carry a little bit of risk with it, given that this is new products, new services, new activity that we haven't ever seen before. So, hopefully I could add a little color to that and, get somebody some ideas around what we've seen here at M&T, what we've been doing, and why we're doing the things we're doing.
So Jeremy was talking a bit about what's potentially coming up in the U.S. But earlier this year, the CARES Act was passed very quickly, and some of the provisions caused financial institutions to change their KYC and AML investigations. How have operations been impacted by the Paycheck Protection Program and the economic injury disaster loans? What sort of lessons also, did you learn from that process? Whatever you can share, obviously, what happened at M&T Bank.
Yeah, absolutely. So I can say it has impacted us. Not in a major way, but without a doubt, we've had to create some tactical teams in the investigations units, very specifically in the FIU, not so much in enhanced due diligence, but getting folks up to speed to understand and look at what's going on in these transactions that are, like we said earlier, stuff that people have never seen before. New loans, new types of transactions that are happening, looking at things much differently from payroll to utility bills and things along those lines. So we've taken a much different approach. The normal red flags that we're seeing out of our behavioral detection platform may or may not catch this activity. They're not specifically designed to do that. So we have really created tactical FIU teams as well as my analytical teams to go and start to really dig into this type of data, looking at wire transactions that didn't exist before, look at how operating accounts are functioning left and right, looking at immediacy of the transactions going out the door once loans getting funded, has been very interesting. And quite honestly, what we found is not only is there an aspect of greed in pretty much any fraud space and AML space, but now we're having to take into consideration desperation, right? There's a lot of small businesses that are out of business right now and trying to figure out how they're going to stay alive. There's a lot of individuals that have lost their jobs and can't pay their bills. So we're trying to take all that in consideration and really have those tactical units get us in a spot where we can understand what's truly nefarious and what's not nefarious. So one of the things that we've been doing, go ahead.
Yeah, what do you think about the guidance that's coming from the SBA? Because I've been reading a lot about, like the guidance seems to be contradicting itself. And, I'll open that up to you, Chris, and anybody else who wants to comment on that. But I think it's become very confusing for financial institutions.
It has been become very confusing. The approach that I could say we're taking right now, and it changes every day, right? The approach we're taking right now is a risk-based approach. Look at those loans that are in the higher dollar amounts, right? When you have the federal government saying, we're going to look at potentially we're going to focus our due diligence on loans over $2 million. Of course, we're going to focus on that. But we've also taken into consideration of those loans that might not be $2 million, but are higher dollar amounts per number of employees that they have. Right. So if it's a small, business that has 6 employees, but every single one of them are making $100,000, that should make the hair on your neck stand up a little bit as well. So we're taking those approaches, and we're definitely not looking at every single loan and every single transaction. We just don't have the capabilities to do it. But we can focus on those top 10% in both of those categories that give us a feel for, all right, if we want to create some sort of automated tools in the future to catch this activity, that will have a good baseline to go off of. I don't want to say we're ignoring what's going on because they're ever changing, but we're taking the approach that M&T is known for its conservative approaches. So we're taking those approaches to make sure that we're comfortable and have reasonable assurance that we're capturing a majority of the nefarious activity that's occurring. And the only way to do that, quite honestly, is to have operations and investigations team work hand in hand with our analytical. So our analytics 3 months ago took a very wide cast of what we're looking at, how we're looking at it, and it was very broad. Well, what we've seen through our investigations and our learnings is that a vast majority of what we're seeing that's suspicious is coming out of P2P transactions after loan funding. So we've been focusing very heavily on now looking at our Zelle transactions, our Venmo transactions, PayPal transactions, because that's where things are occurring. The other thing we've done, too, is not just internal data, but looked at external data as well. So the SBA has produced their list of every customer or every business in the country that's gotten a loan over $150,000. We're very easily able to look at, out of the gate, who's double dipped. So have any of our customers gotten a loan from anywhere else? What are they doing with those funds? So it's been very quick reacting, very much an agile environment, but the operations folks have to understand the technical aspects of how we're going after the data and where we're getting it from. And the analytical folks have to understand the business investigation side of it to focus on that nefarious activity and not create more white noise that's already needed. I'm sure that any bank out there is fully understanding of the impacts of false positives, right? The more we create from an analytics perspective, that's adding to our work volume and not making it easy. So the only thing I'll stay on top of that as well is around documentation, especially for New York State chartered banks and those that would be considered analytics types of models. So we're falling under line of the OCC guidance, as well as New York State DFS 504 guidance around our documentation for any analytics that we're doing, right? How we're making our decisions, judgmental samples, where we're getting our data from, the reliability of those data sets, and the conclusion of these outputs. So I implore you, for those that are doing analytics or ad hoc reporting, to think about that because this does fall underneath the suspicious activity monitoring that DFS 504 specifically talks about.
Thank you. I'm going to pivot a little bit again. We've been talking a lot about the regulatory environment, and I'd like to also get a sense from the audience on how this has affected the automation and digitization at their firm. So there is a question that's up right now. How much has the regulatory environment impacted the acceleration and digitization automation at your firm? So greatly, we have adopted technology to address the challenges. somewhat, we are looking at technology but have not adopted anything yet, or not at all, it's still manual, or we'd leverage more technology but don't think the regulators will allow it. So I'll give this a few seconds, and again, I'm going to defer to you, Karen. Okay, so most are looking at technology but haven't adopted anything yet. Now, Kate, is there anything here that is surprising to you, or is this exactly what you were expecting?
I think it's exactly what I was expecting. I think, when we think about the organizations and where they are with regards to automation, there's a ton of different factors that need to be considered before they fully rely on automation and kind of take out the human element of that. So I'm not too surprised. I do think, to Chris's point, people are starting to look at the technology due to regulatory requirements. But I think they're looking at what's out there and really what they need to get on board with.
Yeah, so I'm going to go to the next slide. How are digitization and automation perceived by those working at the financial institutions? Are you finding resistance? If so, why? And, are there varying attitudes, from one organization to the next? I'd like you to talk a little bit about that, as well as some considerations when making the leap.
Sure. Well, I think, everybody on this panel knows I've used this example before, is that I think it's very similar to cell phone adoption and other technology adoption. You have people that wait in line for the cell phones, the newest automation. You have folks that kind of wait for everyone else to work out the kinks and then get a new phone. And then you have those that are still using a flip phone. And so I think, the factors really depend on the industry, right? The industry and how they're impacted by the regulatory requirements. If the industry that they're a part of doesn't have the requirements or the requirement to adopt per se, they might hold off a little bit on adopting, the automation and digitization. I think from a risk type, there's different types of clients, some that are much higher risk and some that are lower risk. And I think for some of the financial institutions, those that are higher risk are not necessarily ready to fully rely on automation to make that first and second level decisions. They still want to kind of keep that close to the vest. And then there's budget. Depending on the size of your organization, you might not have the budget to actually perform and conduct and purchase the automation. You might have a small number of employees that it's much easier to spend the money on the headcount and have them do that due diligence. Resourcing, again, it's really a headcount. How many people do you have to dedicate to the automation and the implementation? I know a lot of organizations actually have releases that are defined by certain periods every year. And when you add something else gets kicked out. So what type of resources do you have from an IT perspective and a project management perspective, compliance, audit, operations to really dedicate to an overhauling of, the internal systems? Then we also have approvals, right? So we have the compliance folks and the risk folks and the automation that need to make sure that they're comfortable with any sort of automation or digitization that's going to replace employees. I think some of what we're seeing is that there's an opportunity to move some of the first level reviewers to a different avenue of that due diligence and focus on the high risk clients a bit more, but really getting the compliance folks comfortable with relying on a third party vendor to do that level of work and the rationale with regards to settings, and as Chris mentioned earlier, the number of false positives. And then finally, I think regulatory exams play a part. We saw between 2013 and 2018 large banks that were under review from the OCC, Department of Treasury, the Fed. A lot of them had consent orders, got out from under the consent orders, and kind of rebuilt and reworked their AML and KYC programs. So now they're in a space where they spent a ton of money to get everything where it needed to be. And, now we have this kind of new automation. And so, do they really want to make changes now after all the work that they've put in to do this? And if so, can they afford these automation changes based on, some of the fines and regulatory, fines and whatnot that came through with that? With regards to attitudes, I think we have the early adopters and the mandated adopters. We have folks that are very tech-driven and want to be at the forefront. They want to be involved in pilot and testing so they can actually have a say in, how the developers actually create the information to comply. And then we have, the group in the middle that would prefer other financial institutions and corporates to kind of work out all the kinks, let them kind of go through some of the exams and audits. And then once everything's worked out, they're happy to jump on. And then we have those that are really just, once it's mandated, that's when they're going to jump in. They don't really have the time or the resources to focus. So it's going to have to be down to the wire where, you're mandated to do this and there's really no choice. And finally, I think the benefits from embracing the digital change vary. I think it goes back to what I said above, is that it's really, do you want to be in the forefront or do you want to be a mandated adopter? And I think that would really depend on your compliance folks, your IT folks. And I think we've seen a lot of compliance folks that are now starting to learn some of the technology. I think for years, when there were requirements, we'd have the tech folks and the IT folks and the project management folks that kind of had to wear a compliance hat and understand, okay, this is their wish list. How can I make this happen from a technology perspective? But I think as we're seeing with some of the new regulatory requirements is that, the compliance and audit folks are required to understand the technology. They are the ones that are going to get in front of a regulator, not their third-party vendor. So we're starting to see some of those compliance folks have to take on and understand the technology world. So it's been very interesting.
And I'd like to loop Jeremy into the conversation a little bit because, Jeremy, I know that you spent some time at FinCEN, driving these efforts from a technological advancement perspective. Is there anything that you can comment on here from your time at FinCEN without giving anything away?
No, sure. I think FinCEN has actually been pretty good about advertising what they want people to know about this, and that they are receptive, that they want to hear from developers of new solutions for AML issues. They want to see how it works. They want to learn about it. I think there's, and this is not just because it's my old agency, there's a certain amount of humility in FinCEN of they don't have all the answers in this space, but they want to be able to enable the reporting agencies, institutions, financial institutions, to do a better job at AML. The goal of FinCEN and the regulators is fundamentally to get good compliance, and these are tools that can help that happen. And so I would say I'm a huge supporter of Ken Blanco's efforts, and in particular, the new deputy director, Mike Mosier, is I would say has a very good understanding of what's going on in industry and really has a good intention to help financial institutions use technology to better answer challenging AML issues. And I think he would be receptive to institutions coming in through office hours or through other channels to discuss what they are doing to help solve these problems.
I'm sure that's refreshing for everybody to hear, who's in the audience right now. And, I know that I think Kate touched a little bit upon how folks who are in compliance roles are evolving around having technological understanding and know-how. And, I'd be curious to hear, what anybody's perspective is on this, actually.
I'll jump in there. I think it's extremely important. This is coming from somebody that has the technical background, right? So before I jumped into this analytics and automation for all of risk management and regulatory affairs, I was responsible for all the AML technology, data governance, and project management teams underneath our BSA officer. It was, from personal experience, very refreshing with somebody leading the AML department that was very, very focused on the laws and the operations to understand how a technology not only supported what her teams were doing, but how it was a driving factor in creating a program that was overhauled, quite honestly. So having that acumen, at least to be able to speak to it knowledgeably and understand that things can't just happen overnight with a flip of a switch, and the risks that are involved, without just having me be the one delivering bad news every time to say, hold on, slow down, is extremely refreshing. And at the end of the day, she could speak knowledgeably to that, to regulators, to our senior management within the organization. So having that acumen is extremely important, especially as we start moving into the space around machine learning and AI, because the understanding of the capabilities and what it can do from an ROI perspective, without just having it internally be me selling it to somebody to say this is what can we do, and there's that common understanding. It's fantastic to be in that space, and quite honestly, it allows you to think much differently outside the box than just say, how can we proceduralize this? Coming from a technical world, the more procedures you have, the longer it takes to do the job, the more creativity you take away from the investigators, and subjectivity that you take away from the investigators, the longer it takes, the more it costs. And if technology could come in and do the simple thoughts, and then put our investigators in positions to really think critically about, is this a risky event or not, allows for a much more well-rounded investigative team, in my opinion.
Thank you for validating that. I want to go on to another question, and this it may sound a little counterintuitive at first, but are there manual processes that can't or shouldn't be replaced?
I'm going to say,
I'll kick off there.
Go ahead, Rachel, and I'll jump in afterwards.
Sure, I think everyone is probably eager to comment on this one, and I suppose just to pick up actually on the previous topic, that evolution of the compliance officer, it's really about creating that environment that is effective, and that's a really kind of big buzzword at the minute, the effectiveness of what we're doing. And part of that effectiveness is partnering with the right people and the right teams, whether that be internally or, as Jeremy said, engaging with the regulators in a productive and collaborative manner. And really that's how we get to a point where everything that we're doing just becomes more effective and not just a letter of the law or checklist ticking. In terms of then identifying those areas for automation and for digitalization, really what that comes down to is what are the areas that are not adding value or creating or taking up too much time, that really are low risk or low value tasks, as I said, the things that take a long time for individuals to complete, and really it does come down to that ticking the box. We have to fill out this form, we have to upload this form, we have to name this form. They're all things that absolutely digitalization and automation can handle. And, you can go as far as to say, can we make decisions based on some of this information? Sure, but you do that in a responsible way. And I know that Chris has some thoughts on that as well. And really, for me, the whole benefit, I suppose, of automation and digitalization is creating an environment that allows those subject matter experts to really do what they do best, which is making those judgment calls and really doing that investigative work to be able to do them or to make the calls sensibly.
And what about data quality? We were talking a lot about data quality recently, and there's this whole concept of garbage in, garbage out, but there is an even more eloquent way of describing this. I know, Chris, you wanted to talk about that just a little bit, right?
Yeah, absolutely. Data is the key to anything that anybody's going to do, right? From an investigative standpoint, from an analytics standpoint, from ad hoc reporting, and even sending that data directly into your, older, maybe not older, but your typical behavioral detection platforms, right? So, there's definitely the concept of garbage in, garbage out. But I'm going to steal another concept from Jim Richards, who said a couple weeks ago. The one of the major risks is data in, gospel out, meaning that the output that's created, whoever's reviewing it is saying that is the gospel. This is 100% accurate and 100% truth. I think we could probably all agree, everybody on this call, that nobody's data is perfect. It's human nature to have the sort of bad data, and maybe the integrity of your data is not great, or the completeness or accuracy of your data is not great, and that has to be taken into consideration. There's absolutely no doubt about it. So one of the things we're actively trying to do, and it's not built yet, but it's in the back of our minds, is when we're utilizing a data set to create an output, there's data reliability and scorecards that we're doing over top of that data. And it is not to critique the data owners, because the second I critique a data owner, they're going to stop wanting to work with me. It is simply to put our investigators in a position to say, is this data set reliable enough for me to make my risk-based decisions? And that's extremely important, because if you know the quality of your data and it's 85% accurate, maybe that's enough to make your decisions based off of it. If it's 90, even better. 95, great. I'd be hard-pressed to say that anybody probably has 100% accurate data sets out there, but if you do, and you can let me know your secrets, I'd gladly take that on. But it is absolutely a major key, and I know that's a lot of attention's on it. But you also can't stop doing the work just because you have bad data quality. So you have to understand what you have at your fingertips and how it can be utilized effectively.
So I'd like to ask about whether or not you feel that digital automation is actually reducing financial crime. What's working well, what's not working well, and I know, Kate, too, you had an opinion about this.
Sure. I think what's working well so far. Is the ability for the automation to kind of do that first level of noise, right? So you take what your organization has with regards to settings, fuzzy logic, true match. And when you have a feature and you've built in those customizations, it really allows you to present just the matches or the information that are relevant. So that first level of defense, going through the algorithms and having the automation really do that work for you, as long as they match your global policy. You've had compliance and audit and QA involved in doing a lot of testing and regression testing. I think that's where we're really seeing some good results. It's really allowing the results that are presented to have the head count and the people that are looking at them know that it's not a lot of junk they're getting. It's not a lot of noise. Whatever was presented is valid. I think what's not working well is just really, I don't think we're ever going to get to a place where something can be fully automated. There's clients that have risk scores. There's regulators that want to understand the rationale and the evidence behind decisions as far as if you're going to board this customer or maybe board them at a low risk rating versus board them at a high risk rating. And then for those refreshes, are you going to exit the relationship, change the risk scoring? So I wouldn't say it's not working well. I just think it's a component that I can't see ever going away. But who knows where we'll be in a year with that? Maybe it will. And then I think the other thing is really to echo what the folks on the call have been saying. In order to get that first level working well, the data needs to be there and the data needs to be good. You put garbage in, that's what you're going to get out. And so I think where it's not working well is where those institutions don't really have all the customer attributes that need to be in place to be able to make a really clean run.
Yeah,
Susan, can I jump in and add one thing there? To add on what Kate was saying is, and this is coming from a technical person that wants to automate everything. Not everything can or should be automated. There's way too much subjectivity that comes into play. And I'm going to steal another line from somebody else that I heard is investigators have to have empathy in certain situations, right? And that empathetic thinking cannot be replicated by a machine. And empathy comes into play for, especially I would argue in this environment, the desperation, right? People aren't doing things because they know it's illegal. They might not know it's illegal, but they're desperate to pay their bills. They're desperate to keep their business alive. And if you don't have an empathetic thinker and you're just having a machine do it, you're gonna create SARs where they might not need to be created. You're gonna create more nefarious activity that exists within your bank because of a certain strict set of rules. And that empathetic thinking can't do that level of work. So that's something else I'll throw out there.
Yeah, I'd like to follow up on that if I could. Mm-hmm. And I think empathy and the limits of some of the data science is that bias can also creep in when you're being an empathetic thinker, which is, as a former intelligence analyst, I agree, that's something that you do need. But you also have to protect against inherent biases. But I would also caution, if you think cold data science is going to fix your bias issue, you are profoundly mistaken. The computers don't think for themselves. They are told to think what we tell them to think. And the bias of the programmer certainly creeps its way into the work. And I think that's something we need to pay attention to as AML professionals, that, as Chris says, we're not putting out SARs that don't need to be there because of our biases taking over and creating villains where there aren't.
I say, Jeremy, I'm going to add one more thing onto that because I totally agree. There's excuse my language, but there's the cover your ass SARs that put you in a position that your model can't differentiate between the two. And now those biases are without a doubt in there, and you have to pay attention to it. Great point.
So I want to be cognizant.
Very quickly, time. Susan, I know you're trying to move on, but that's precisely.
I know this is a hot topic. Go ahead.
Just that's precisely the issue that we've seen across Europe and indeed the world, is that where you have those SARs that are submitted just because people don't want to be pulled up later down the road. And ultimately, that's taken away from valuable time at the investigation side. So really taking that risk-based approach and actually embracing that risk-based approach instead of saying, you know what, I'm going to cover all possible bases here and just get this in.
So thank you all. I want to be cognizant of the time. There's about 7 minutes left. We have a polling question. There is a couple of Q&A questions that have come in that I think we should address. And I also want you guys to finish with your key takeaway for the audience. So that'll take us to the end. So I'm just going to move to the next polling question. And is it up? Yes, it is. Okay, hold on just a second. What is the first thing that your financial institution does when selecting or reviewing a vendor? Do you look at the automation features of the tool, the history, trail, and supporting documentation of the information that's presented within the tool, the pricing, or the ease of use of the tool. So I'll give a few seconds. Do we have the results yet? Okay. Are there any surprises here? Does anybody want to comment?
So I think the results are great, actually. I think, you know, a lot of times I think that pricing is the biggest factor. And so it's nice to see that I think organizations are realizing that the compliance departments are, you know, worth the price. I think for some time, if something was too expensive, it was, let's move on to who we need to go to get that box checked. And so it's really great to see kind of the change there. And, you know, budgets are being allotted for more compliance requirements. And I think the ease of use of the tool is, I mean, I agree. I think if the tool is confusing, if you can't get what you need it to, you know, some of the record retention laws are, you know, you have to be able to get into the tool very easily and produce the information quickly. And so, you know, I think the ease of the tool and being able to do that should be on everyone's forefront. So I think the results are great.
I have a quick question here from one of our audience members. And are all banks required to comply with the CARE Act forbearance timeframes of 180 days with an extension of another 180 days, 360 days total? I'm thinking, Jeremy, you might have an answer for that.
Unfortunately, I don't. That is something that I haven't looked at particularly closely. I know that there are a number of resources available that has that information readily at hand. I don't want to do attorney advertising, but I think my firm's website may have something.
Okay, I think we could probably, Karen, you can tell us, maybe we can provide some information after the event. And you know, I'm cognizant that there are only a few minutes left, and I really want to go around the table to get the key takeaway from each of our panelists for the audience. And I'd like to start with Kate first.
Sure. So I think my key takeaway is to plan. You know, don't wait until it gets closer. I think you know, budgets, I think, you know, a lot of organizations have budgets done the year before, or the third and fourth quarter of the prior year. So when you see the regulation coming out, just get that budget ready, get it in a release early so other things aren't pushed out and you can make sure that you can meet the requirement. And then also get all the right people involved, right? You've got your compliance people, but you've got IT, project managers, the QA and internal audit folks that are going to be the ones, you know, testing this before the regulators get in there. So get all the right people involved, get on your release schedule, and get your budget prepared. And Chris, I'd like to pose that same question to you. What is your key takeaway for the audience?
All about the data, right? So data in, gospel out. You could find the best data that you could utilize it for analytics or automation. That's the key driving factor. So that's where all my focus is on. And then, you know, like Kate said, find the early adopters, find the people that are willing to raise their hand and jump in and try something new that they haven't tried before. So that's my two biggest things that I'm always focusing on.
And Rachel?
I think, you know, if we take into consideration everything that we've gone through on the call today, it's focusing on effectiveness and doing it in a collaborative and effective way with the industry, within your own financial institutions, and ultimately with the regulators. And at the end of the day, being cognizant that we're trying to get to a point where we're creating an environment that is a deterrent for financial activity that's illicit. So how do we do that best, rather than focusing too much on the what's, the whys, and the hows, but creating that environment as a community?
Yes, and Jeremy, last but not least.
Thanks. I think I'll circle it back to where we started, and this is a topic on US AML reform. I would say you don't have to wait for AML reform to happen to make your AML compliance programs more efficient and more effective. There's a lot of things you can do, and now is probably the most receptive time in recent history that regulators have been to innovative efforts by financial institutions. Think through the problem, come up with a solution, and pitch it to regulators. You may be surprised at what you're able to do.
Excellent. I want to thank Refinitiv for hosting this webinar and our fabulous panelists. Thank you so much. And, if you can complete the survey on your screen, we thank you very much for attending.
Thanks, Susan.
Okay.